Hey everybody, welcome back. This is day number 10 in our 15-day personal finance overhaul program. Let's get started. Lots to cover today. So yesterday, did a great job. We're convinced that we need to start saving for retirement. We want to make the most of our employer match. And now I just threw a whole bunch of new question marks at you. How do I invest for retirement? What is a 401k plan? What do I do with my money? What stock should I buy? What bonds should I buy? What savings account should I use? So many questions. Let's go ahead and start clearing up those questions so that you can understand the process. So let's start off with getting a couple of things straight. There is a difference between saving and investing. Savings simply means you're protecting what you have. Put $1,000 in the bank and you will always have $1,000. Investing is when you take your money and put it to work for you in the attempt to make more money. So you can invest in many ways. You can buy gold, you can buy jewelry, you can buy art, you can buy a lawnmower and start a landscaping business. Anything that you buy and put your money into with the hopes of making more money is an investment. But for our discussion purposes, we are going to talk about stocks and the U.S. stock market as the way to invest. So let us get some things straight. We want to start investing, but the money that you have in the bank is actually losing value. Didn't I just say it would always be 1,000? I sure did. But $1,000 today buys a whole lot more than $1,000 is going to buy you when you're 65. Okay? Remember Grandma used to say she could buy a loaf of bread for a nickel, and now it's $2? That is inflation. So saving your money means that your money is exposed to the loss of buying power over time due to inflation. Therefore, there should always be a portion of your investments, even your savings, that are invested to stay ahead of the negative effect of inflation. And when it comes to retirement savings or investing in the stock market in general, a rule of thumb, obviously not the law, a rule of thumb is generally accepted as 100, as in 100%, minus your age equals the percentage that you should have in a growth investment, something that will grow and stay ahead of the market. Now, you can't always be in growth 100% of the time because you don't know what the stock market is going to do on a day-to-day basis, and there may be financial milestones approaching that you can't risk losing your money for, such as if you know that you are going to get engaged and married and buy a house 6 months from now, you may want to lock in any growth in the stock market today, because if the stock market goes down 5 months from now, you won't have enough money for the down payment on your house. And the same thing applies to retirement. If you're approaching retirement years, you may want to start shifting funds from up and down growth securities into something a little bit more stable and protected to make sure that you will be able to retire. But a portion of your money always has to be growth oriented so that you stay ahead of inflation. So let's talk a little bit about the stock market. What does that term even mean? And how do we make sense of it all? So what I've done here is I'm showing you an index, one of the many indices that exist. The Dow Jones is one of them. NASDAQ is one of them. Those are names you may hear when you listen to the news at night, including this one called the Standard & Poor's 500 or S&P 500. And what these indices do, these investment firms go ahead and collect a certain number of stocks. In this case, Standard & Poor's is a company. They selected 500 stocks for their stock index, and those 500 stocks effectively represent the thousands and thousands and thousands of stocks that are available on the stock market. So 500 stocks generally represent the stock market. So when someone says, what did the market do today? They're looking at an index and seeing if the price at the close of the market is higher or lower than at the opening. If the price of the market went up, they say the stock market closed up today. If the prices of the stocks happen to go down, then we say the market went down today. And it really, unless it's going up every single day or down every single day in a row, we really don't care, right? It goes up and down. And we see that here on a 1-day view about 2 hours, 2.5 hours into the stock market being open on this particular day. So you see that the stock market, the value goes up and down, up and down, up and down, up and down. Okay, well, that's not very stable and it's not very reassuring, but let's back away from a 1-day view and look at it over 1 month. And what you still see is a lot of up and down, up and down, up and down. You say, gosh, Paul, that's really risky. That's still not stable enough for me to bank on my retirement. Well, let's take a step back again. And now let's look at this up and down line over 5 years. And what we see is that the stock market bounces up and down, but it bounces up and down on a generally upward trend. So much so that there is very little investment over any 10-year window that outperforms the stock market. Okay, so stock market bounces up and down, but generally up and down on an upward trend. So over time, the stock market is pretty much your friend. It is where you want to be in order to stay ahead of inflation. The standard disclaimer always applies. You will start to hear it now that you know to look for it. Past performance is not a guarantee of future results, right? So the stock market could tank and go zero, right? Like it did in the Great Depression. But no one's expecting that to happen, right? So understand that, no guarantees, but when you look at the available data, what we see is upward trends over any 10-year period. So the stock market is kind of where you want to be. So now we've got this idea that we're going to invest for retirement. We're going to get this money that comes out of our paycheck, and we're going to get this extra money that comes out of our boss's wallet as an employer match. Now what do I do with it? So I want you to just envision a farmer carrying 2 buckets, right, coming back from milking his cows. Bucket number 1, both buckets, by the way, are for retirement. Bucket number 1 is what we call a traditional or a pre-tax plan. The money that you put into this bucket is money that comes out of your paycheck before the federal government sees it and applies their taxes to it. So you are putting your money out of your paycheck and into your retirement bucket before you pay tax. So if you were earning $50,000 and you put away 10%, you're putting in $5,000. At the end of the year, when you get your W-2 form, your employer is telling the government you did not earn $50,000, you earned 45. You will pay less taxes today because there's less income, nod, nod, wink, wink, because you took the money out of one pocket, you put it into another. And that sounds really, really attractive. Please understand that something else applies. There's tax ramifications, tax code restrictions on all retirement money. In this bucket, in your traditional bucket, remember that the government will always punish you or reward you financially in order to get you to behave the way they want you to. They want you to retire with money in your pocket. They want you to save for retirement. If you touch retirement money early, they will punish you with a 10% penalty. And then you still have to pay the taxes on it. Since you didn't pay taxes on it when you put the money into the bucket, you will pay taxes when you take the money out of the bucket. But that's not the only bucket choice for you. There is another bucket called a Roth or a Roth Plan. You'll hear it referred to. These are contributions that you make after paying taxes. So this is literally using the money in your pocket and putting it into a retirement bucket after tax money. The nice thing is, from the tax code perspective, is you can access this money. You may access the amount of money that you have actually contributed and already paid tax on with no taxes and no penalties. It's your money. The savings, the earnings are magically transformed into retirement dollars that you cannot take until you reach retirement age. Okay, so your growth is untouchable, but your contributions are accessible. And of course, I would always tell you not to touch retirement money. Let it grow. It's there in that special bucket for a special purpose that you cannot avoid, right? You're older today than you were yesterday. Father Time is ticking away, right? Now, the beauty of a Roth is that when you go to retire withdraw your money in retirement years, 100% tax free, all of it. Okay, so you already pay taxes on your contributions, but the hundreds and hundreds or maybe millions of dollars of growth, 100% tax free. I always recommend a Roth bucket for your retirement money. Okay, now that you've put money into the Roth bucket, in that bucket, you will take that money and you will buy a certain amount of stocks, bonds, mutual funds, electronically traded funds, precious metals, whatever you're able to invest in. Okay, so but it all happens within one of those two buckets. So here's your to-do list. Day number 10, these are your action items. Contact your HR or benefits office and find out what retirement plan exists where you work and if you are able to participate. If you are a new hire, you may have to stay there for 6 months to a year before they allow you to participate. You may or may not have a match. You may or may not have a Roth option. I don't know of any place not offering a Roth, but I just threw that out there as food for thought. Okay, so find out the details of your retirement plan. Understand that what you invest in, and when I say the U.S. stock market, there are thousands of stocks. Some are very aggressive and can reward you greatly. You can also lose everything. And some are a little bit more stable and they're not going anywhere, like McDonald's, right? You've never seen a McDonald's close down and worry about McDonald's going out of business, right? So some stocks are very stable, some stocks are very aggressive. You need to speak to a professional to make the proper choices and in the right balance between growth and more stable, more conservative, and savings to protect what you have. You got to find the right balance and you need to find the right particular places to invest. That is done with a professional. If you have a retirement plan through your work is probably having that plan monitored, sponsored, and administered by one of the big names in the banking industry. T. Rowe Price, Merrill Lynch, Fidelity Investments, etc. Those banking resources will offer you a financial planner, an advisor that you can call over the phone and say, hey, I'm trying to figure out what my choices are, what I should do, etc., etc. And they will walk you through finding out what your risk tolerance is, what your growth plans are, what your time horizon is, and they will help you make these more granular decisions that it is not my place to make with you. Okay? Take the time to research your options, talk with a professional when you make your choices, and please, 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 the sooner you start, the more mathematically advantageous this is over a 30-year time horizon. So you got to start early. The minute you are earning money or the minute your children are earning money, you should be investing for the future. The compounding interest power over time is phenomenal. So get started right away. And that's my message to you. Execute now. Now. There will be no change to your life without clear and decisive action on your part. See you tomorrow.